What is the market telling me this week? Welcome to the Nick Rutherford Report. And the market is either going to take advantage of you or you're going to take advantage of the market. And if you take advantage of the market, you can be a super investor. So hit that like button, subscribe to this channel, leave me a comment, share this with someone who would get a lot out of it, because this is the place to be for the financial news that matters for your net worth. Let's get to it. Stocks pump and dump after Waller advocates for front-loading rate cuts. So, Bitcoin's down, Brent is down, the market is going crazy today, all on the jobs reports. Let's look at some of the highlights from the market and figure out what it means. So, here is something very interesting that's worth pointing out. A job shock, they call it. 1.3 million native-born Americans just lost their job, replaced by 600,000 immigrants. So, why is this important? Well, let's look at the graph here. You can see, using this graph, that the jobs may be higher, but apparently they're reporting a lot more immigrant jobs compared to just people who've been in America. Now, the only reason I point this out is because those are probably lower paid jobs. So it's unclear how this data is going to trickle through and cause investments to go up or down. But it's very suspect, I should say to the least, so it's very much worth pointing out. And remember, Wall Street is always trying to take advantage of you. And if you want to take advantage of it, we need to look through this chaos and find out what the market is telling me. And it's telling me some very interesting things. Here's a better version of that chart. I put it a little bigger so that you can see. So you can see that we have fully recovered to the previous 2019 highs, and now we're going even higher. So the economy is cooking. And the jobs report came out today, and it is very interesting. I guess my prediction was correct with fiscal pushing through, and we're going to get to that in just a sec. Now, Goldman reveals a shocking collapse in visits to ChatGPT website. So let me pull up the graph here just to show you. So here's the graph. Now, I've been using this thing, and it seems to be getting smarter and smarter, and it helps me do all sorts of tasks in the digital world. So I'm expecting that AI is the next big thing. It's just going to take longer to materialize than a lot of people think. But that doesn't mean that the Mag 7 are going to have lower and lower earnings. In fact, they've been higher. They've been beating all year. So it goes along with my theme of investing, of invest where there's expansion, invest where there's growth, invest where things are happening and not in things where everything is going bad. Because there seems to be, again, two sets of the economy. There's the digital economy, the new stuff that's expanding, and there's the old retail economy geared towards people of modest and moderate incomes, which are very much a place where everyone is struggling because of inflation. At least that's what all of the data would tell me. Now, here's some interesting data that came out. The June payroll missed, but unemployment rate declines, pulling back from the SOM recession trigger as wages unexpectedly rise. And this is huge news, and we're going to get into the data because I like the data to really tell me what to do. One other interesting piece of data that we're talking about here is Warren Buffett is dumping a ton of Bank of America. Questions swirl as to why. No, they don't really swirl, because if the analysts took the time to watch his meeting, it looked like he was very concerned that the corporate tax rate would go higher. So I can think of three reasons why he's selling. One, he's unsure about Bank of America. That's a possibility. What do the future hold? Two, Bank of America is very expensive relative to its past. So I know for a fact, if you listen to Warren Buffett, he regrets selling Coca-Cola when he thought it was very overpriced. So it could be he thinks that Bank of America is currently overpriced. Or it could be simply what he said in relation to the corporate tax rate at his shareholder meeting. He said corporate tax rates are lower now, so he could be trying to lock those in because he's worried about the next administration coming in and raising his capital gains tax. So he's trying to lock in his profits and then just pile up the cash so when he sees deals, he can move on to that. There's lots of reasons, so I wouldn't be freaking out about them because the data is telling me the economy is great. right now as of today, and we're going to get to that in a second. In fact, I've uncovered something very interesting that you're not going to want to miss that's kind of shocking. Okay, here's the next thing I want to point out. U.S. manufacturing ISM signals accelerated stagflation as PMI turns downright apocalyptic. So this piece of data came out. To me, doesn't look terribly apocalyptic. If we scroll down here and really get a good look at this chart here, it's bad, but, you know, we had apocalyptic back here during the plague and during the great financial crisis and during the dot-com crash. So, you know, with it hovering down here around here, it's just low. We're near contractionary territory, but there's no way it's apocalyptic, and that's just Wall Street trying to freak you out. So let's get to the data, because what happens next and what am I doing about it all comes down to the data. And we've had some great data come out this week. Here's one thing I really want to point out, and let me see if I can center this chart for you. So here's a chart that I found from HBKS Wealth Advisors. If you look carefully at this chart, you can see they're tracking market returns since 1932, just the average here, based on no election years, that's this top line, and then on election years. And now, if you look closely at the difference here, you can see that here we are in September. Usually in a no election year, it just kind of grinds sideways. It's not really the best month for stocks, but it's not, well, it might even be on average one of the worst months. September and October, right here, you can see there was always a drawdown, as well as in May into June. So, but these are significantly more pronounced in the election year. So the presidential election year is this lower line, and you can see that the downward draft in stocks is like much more than with no election. It looks kind of flat in the year with an election. It goes down and down, and then probably maybe the election is this dot here. I'm not sure. Somewhere around here is going to be the election. It stabilizes, and then it goes up. So usually markets hate uncertainty. This is just something that I've noticed. And if everyone's uncertain about what's going to happen next, they're going to reposition themselves. Things are going to change around, and that really is going to determine what happens in the future. And as soon as the election comes, then all the uncertainty's over and the market goes up. Now, of course, there could be some sort of economic shock in the cards that we don't see yet, but we're going to have to wait to see what that is and if it happens. So next, let me get to the unemployment here. So here's the report. I just zoomed in on it. This is from the BLS. It came out today, 4.2%. You can see that right here. Now, what's great about that is it's come down from 4.3. So if the data is trending in that direction where unemployment is getting lower, well, that's going to be great news for the economy, because the more people employed, the more income they have, the more spending they do, the more corporate profits they have, and then prices of everything goes up. So that's great if you're an investor trying to build wealth in the stock market. Now, I want to move on to more data. This is something that I consider very, very interesting. Let me try to just get this here. We'll go through this graph. So this is a graph here from George Robinson. And if I look closely here, he's at Bicker and Brattle on Twitter. And this graph is really fantastic. So this is just something that I've noticed, and this is the market telling me to do something. Right now, I haven't said this before, but the market is telling me to do something now, because the yield curve derived from the U.S. Treasury and the risk-free rate is disconnected. Now, what does that mean? Since 1989 all the way through 2022-ish here, they have been in lockstep. You can see that the risk-free rate is the same as here, the yield derived from the Treasury. So something is going on here in the last year and a half that has caused an entire point disconnect here. You can see that we're now approaching this almost 1% disconnect, where they used to travel in exact lockstep. Now let me give you a different point of data here and then really explain what I mean by that. So if we look at these graphs here, let me just center it on here. Hopefully this works for everyone. So if we look at this graph here, here is the 30-year Treasury and the 30-year mortgage. You can see that they are tied at the hip, and usually they are about 1 percentage point difference. You can see back in 2015 that the 30-year Treasury, that's the red line, was trading near 3%, and the 30-year fixed mortgage, the blue line, was trading at 4%. There's about a 1% discrepancy here. Now, since about 22 and a half, as they started raising rates, there is an added discrepancy, and you can see that it's building, and it's or been building. That's not an English sentence there. So in 2023, there is an entire extra point added on between the interest rate here. Now, why is this the market telling me something? This is telling me, I'm speculating here, but they're obviously potentially doing some sort of backroom yield curve control right now and nobody is even noticing. Because this correlation, if you look at that previous chart here that I had, right here, this correlation has gone back since 1989, and it has just broken recently. And my speculation here is that for some reason, they're suppressing the yields in some sort of way, because if normally the 30-year Treasury is 1 percentage point below the 30-year mortgage, if the 30-year mortgage is at 6.5, the 30-year Treasury should be at 5.5, and right now it is at closer to 4.25. That's huge. What does this mean? This means that there's some sort of yield curve control happening, and they're monkeying with the yields, and this is causing extra inflation embedded in the system, or extra devaluing of the dollar that maybe we're not even seeing right now. It's not coming out. And why is this so important? Because this is some sort of stealth yield curve control. And maybe this is why we've had such an inverted yield curve, yet we haven't had a recession yet. I know I really shouldn't say this time is different, but this data is saying wake up and pay attention, because what's happening here is potentially a monetary debasement. And that's going to mean that gold is going to do really well. And you know what? Gold's been doing really well. And this is a shocking signal that I don't think anyone is talking about. And most investors don't know how to protect themselves. So what am I doing? Well, right now, I'm going to hold an emergency Zoom meeting where I'm going to go over my research on Monday night to talk about an investment that I've uncovered that could benefit from this market phenomenon. So if you want to be a part of that, you can go to my website, which is highreturnlowrisk.com. Go ahead, click on this button right here at the front of the page. It's going to take you over to a Google Doc right here that is just going to explain how to take part in this meeting, where I'm going to reveal what I'm watching, what my research is indicating this means, what I'm investing in to take advantage of this market situation right now, because this really could be a fantastic market opportunity. And I don't think anyone is seeing this, because this has profound implications on what happens next. All you need to do is look at this correlation breakdown, and if they're monkeying with the yields, there's a theory that the only theory that I could find about this is that they're doing so many short-dated bonds that they're crowding out the long bonds, something like that, to push down the yields. I don't quite understand the market dynamic behind that or how to measure that, but I can see plain as day that there is some sort of yield curve control or de facto yield curve control happening right now. Literally nobody is noticing. So this can have profound implications, and it can also create that monetary inflation, which gold typically does well during. And I have found the most fantastic gold miner to take advantage of this situation. It's just completed a mine and it's trading at rock bottom prices. In fact, next year, as the mine comes online, it's going to be trading at 5 times earnings. At least that's the projection. What I can tell, it looks pretty close to that. So if this continues and gold continues, this is really going to be a huge benefit. And this is why I always look at the market to figure out what should I do. And the market is telling me, well, here's a time to do something. And on Monday night, I'm going to share all about that. So if you want to be part of that, go to my website and we'll get you hooked up. Now, I want to talk about the next thing here. Let's quickly look at the market. The market is kind of up. I mean, it's not up today, but we are within a trend. And you know what? If the unemployment data is coming down, it's not going up, well, I'm going to continue to be bullish. So this looks to me like a choppy market, a little worried about what's going to happen, but frankly, the market's down today, yet the data says time to celebrate because the unemployment rate is at 4.2, negating all of this SOM rule stuff. And you know what? I'm long, and I have found something in the market that I can take advantage of. Will it be a huge opportunity? We'll find out. I'm going to go through it on Monday. Now, Bitcoin, look at that. Bitcoin is consolidating sideways. It has had a great year. I'm not too worried about it. Seems to be holding the support. If it breaks down severely, then I'm going to be worried about it. But this is typically the time when Bitcoin goes bananas in the next 6 to 1 year, if history is any guide. So we're going to have to see what happens there. And if I look at NVIDIA, the most important stock in the stock market, only because it's the leader in AI and that's where everyone's making the money right now, well, it's holding right here. And until it starts to go down and becomes in a bearish trend, I'm not really worried about it. Yeah, it's extremely volatile, but that's because there's so much uncertainty around it. But what I'm completely certain of is trends, and I like to invest in trends. And one of the trends is there's going to be AI. There's going to be more data centers. There's going to be more chips. Bill Gates is going to keep working on it. In fact, he was on a podcast and says there's at least 2 more cranks, meaning he's got to update it a bunch more times, like 2 big more times at the very least he can see. So this is going to mean tremendously more data centers and tremendously more AI. I still think we're at the beginning. It may take years for this to play out, but there are definitely investments that can take advantage of this theme. And that's one of the things I do. I always want to see a trend and take advantage of that trend. So if what I'm pointing out, this potential yield curve control is happening, there's a trend there that can be taken advantage of right now. So I'm going to take advantage of it, and I'm going to talk about that on my private Zoom meeting on Monday night. You can get the details at my website. So what happens next? Well, unemployment gets worse and the market grinds lower. That is entirely one of the main options. Or the fiscal propels the market higher and there's nothing else matters. And this is my base case. I'm still 100% long. I'm very worried about the data, but now with unemployment down to 4.2% that came out this morning on, what date is today? Today is Friday, September 6th. You know what? I'm not so worried because that makes the data more bullish. And then I get to be more bullish. So that's really what I think happens next. These are the 2 scenarios. Right now, I'm going with scenario number 2 of the fiscal propelling the market higher. So I'm going to continue to watch to see what the market is telling me to do and take advantage of it when I can. I'll be taking advantage of this yield, how do I say it? It's a discrepancy because it should propel gold higher. There's some great gold miners to take advantage of that I'll be sharing that I've found. So if you want to learn about what I'm investing in, you can go to highreturnslowrisk.com and sign up for the webinar training where I'm going to go over my research on Monday night. And next week, well, the data could change and I'll come back out and I'll have a new announcement. But until then, let's watch the market because the market will tell you what to do. And that's what a super investor does. They wait and they see an opportunity in the market and they take advantage of it. So have a good weekend. I'll talk to you soon. How am I using this information to protect and grow my wealth? Go to highreturnlowrisk.com.